Welcome to Finance with JC, episode 4, how to invest when inflation is high. Josh Clancy here. I'm about to show you how inflation is quietly stealing your wealth and what you can do to fight back. So, if I told you that keeping 100 grand in a savings account earning 2%, 2,000 quid a year, but inflation was running at 4%, it's actually guaranteeing that you're going to lose 2 grand rather than gaining it that you're getting on interest. You're losing purchasing power every single year. Inflation is what we call a silent wealth killer that most people don't understand until it's too late. But here's the thing, right? Inflation destroys the wealth of people that are not prepared. You can actually accelerate wealth for the smarter and the more savvy investors. This is the people that know how to position themselves correctly and what to do when inflation is high. So I'm going to show you today exactly how it works, how inflation works, why cash is not king during inflationary periods, and very specific investment strategies that not only beat inflation, but they thrive because of it. Okay. So if we think about some numbers for a second, UK inflation has averaged 3.2% per annum from 1990 to 2020. Doesn't sound like much, 3.2% inflation per annum, doesn't sound like much. But 100 grand in 1990 needed to be £234,000 in 2020 to buy the exact same things. So money that is sat in cash over the last 30 years has lost 57% of its purchasing power. Big numbers. In 2022 to 2024, UK inflation peaked just above 11%, and it's been hovering around 3.5 to 4% ever since then. What this means, running at 4% inflation, your purchasing power halves every 18 years. 50 grand today buys what 25 grand will buy in 18 years time. That £2,000 monthly income that you think you need in retirement then becomes £4,000 in 18 years time, just to have the exact same lifestyle. When UK savings rates are running at 1 to 3%, you've got inflation running at 3 to 4, you're netting zero, or you're losing money. Okay, this means that cash is guaranteed to lose purchasing power over time. It is not safe in terms of future value, and it just destroys wealth. What a lot of people do, 45-year-olds plan to retire at 65, inflation reduces that purchasing power by 50-55% just in their retirement period alone. Right? This is why the safe retirement planning often leads to a retirement disaster. Okay, I've spoken about how to allocate funds and asset allocation in retirement loads of times. Have a look at my videos. What you need to understand is that when the governments print more money chases the same goods, which drives up the prices. We see massive, it's called quantitative easing, massive amounts of printing money since 2008, and especially since COVID. Everybody thought like dining out, eating out to help out, all that was always going to come back around. I was very vocal about that at the time. You've got supply chain disruption as well, so like energy crisis, pandemics, geopolitical tensions. Prices tend to prices rise, and it balances out supply and demand. You've got wage prices, workers demand higher wages to cope with higher prices, businesses raise prices to cover the costs, and then it's just a reinforcing cycle after that. You've got energy and commodity prices, so oil, gas, food, raw materials, affects the price of everything else really. When these spike, inflation increase is inevitable, right? And then you've got government policy, increase in spending, low tax, low interest rates, these all contribute to inflationary pressures. Right? And they can last a lot longer than people think as well. So central banks do struggle to maintain inflation without causing recessions, and political pressure makes things a lot more difficult. This means that investors need strategies to work across not just different inflationary environments, but also within temporary hedges as well. So before I tell you what works, let me explain what gets hammered by inflation. Cash equivalents, so savings, money market funds, short-term bonds, anything earning less than the inflation rate guarantees wealth destruction. If you're earning a 30-year bond which pays 3% and inflation it jumps up to 6%, which we've seen isn't impossible, you're locked into a 3% loss of purchasing power annually for decades. Okay? You've got fixed annuities paying fixed amounts, they actually become less valuable every year. Inflation erodes their purchasing power. You can actually bolt on indexed annuities and things like that to combat that. Life insurance cash values, whole life policy typically earn 2 to 4%, again behind inflation. Your traditional pensions, your goals-plated pensions, final salary, defined benefits, most of them are linked to the RPI or the CPI, so they are generally okay. Your term deposits, I think I've covered that off, but essentially if you're locking in like a 36-month term deposit, it's a big risk in my opinion, especially while inflation's at the current level. Okay, so anything that is fixed below the rate of inflation, then it's not necessarily a good bet. Okay, even if it is guaranteed, it might be guaranteed on paper, but it's also guaranteed to not beat in inflation. So, what does beat inflation? Well, let me show you now let me tell you now what that would look like. Equities. Companies can raise prices when their costs increase, passes the inflation through to customers. Over long periods, stocks have beaten inflation every time, and they are the best inflation hedge. Okay. Quality companies with pricing power, they excel during inflation. Dividend stocks as well, they provide income over time, and international stocks like US, Euro stocks, so they provide currency diversification. You've got real estate investment trusts, so property values and rents, they rise with inflation, we all know this anyway. REITs have exposure to property without direct property ownership, which means you have the headaches that come with it. You have your commercial property, their rents generally escalate with inflation. They even have clauses in the rental contracts as well. And like I said before, property values historically track inflation over time. Okay, REITs provide liquidity that direct property doesn't always provide due to void periods and things like that. Your commodities, raw materials, so energy, agricultural products, and they all rise or generally rise ahead of inflation. Gold preserves purchasing power over decades, and energy stocks as well, they benefit from higher oil and gas prices. We've seen that happen over the last couple of years as well. Agricultural commodities, they protect against food inflation. Okay. And then you've got your government bonds, where the interest payments are based on inflation. These are called TIPS. TIPS, Treasury Inflation Protected Securities. These are government bonds that adjust principal and interest payments based on inflation. The value or the principal value increases with inflation. Interest payments rise as the principal adjusts upwards. Okay, so this gives you like direct inflation protection. Then you've got your international investments as well. So let's look at the UK, where inflation, like I said before, has been quite stubborn over the last couple of years. The equity market as well, I mean, it reached all-time high yesterday, but over time compared to the US massively outperforms. So investing in foreign equity is actually quite a good way to go. You then have your emerging market shares as well, which can give you the volatility but also it will help prop up the portfolio as well in times of inflation periods. So the stock market inflation strategy, okay. What you want to look at are companies with pricing power, looking for businesses that can raise prices without losing customers. So think of like your luxury brands, LVMH, Hermes, companies like that. Okay. You then got your essential services, so telecommunications, utilities, strong brand names, Coca-Cola, Microsoft, Apple, healthcare companies with patent protection. You then got your dividend growth stocks. I was going to call them divvy stocks there, but divvy in some countries doesn't mean something good. You could say I'm a divvy for saying that. But again, dividend stocks again will give you the income, and the income will generally rise with inflation. Okay. Utilities with regulated price increases as well. Consumer brands that have steady cash flow. You then have your value stocks over growth stocks. So during inflation, investors prefer companies trading at low price to earnings ratio rather than high. Businesses with current cash flows rather than future promises. We are expecting to get this contract compared to we have this contract, okay? And companies that have real assets with tangible value. All right. Expensive growth stocks get battered during inflation because future cash flow is worth less when discounted at higher rates. Higher valuations become harder to justify. Investors rotate towards current income and value. All right. So when we talk about sectors and what people's preferences are, you've got your energy sector, benefits from higher commodity prices, financials, benefit from higher interest rates, your materials, so commodity exposure provides inflation protection. Real estate, we spoke about that. Property values, they rise with inflation. Commercial property rentals also rise with inflation. And then you have something a little bit more sophisticated, okay? So floating rate bonds. Bonds that with interest rates that they adjust based on the current market rate. So for example, bank loans that reset quarterly, floating notes that are tied to central bank rates. They provide protection against rising interest rates. They work really, really well for the right type of investor. So, what mistakes do we see? So, there's a few. Mistake number one, thinking that cash is king and staying in cash for too long, waiting for clarity in the market while inflation, like I said, just destroys the purchasing power. It's the best time to act is in the run-up, not after. Okay. Then you've got buying long-term bonds where they lock in low rates for decades during inflationary periods. Bond prices fall, interest rates rise. That's how they combat inflation. Right. Focusing on nominal returns, so looking at the account balance rather than the actual purchasing power. 5% return with a 7% inflation is a 2% loss in real terms. Panic selling. This is really where the financial advisor can add a lot of value on the behavioural side of financial planning, but essentially selling when there's volatility and crystallising losses. Energy stocks and commodities, they all fluctuate in volatile markets, but over long term they will give you a good hedge against inflation. Okay. People sometimes have a home bias where they only invest into their home country because that's what they know. A good example of that would be people purchasing stocks that are in the UK rather than looking at international markets, looking at the best performing economies, US, perhaps China, Japan is starting to become a bit more popular. You've got India there as well. So sometimes it's about just broadening your horizons there. So then that brings me on nicely, I guess, to how to construct a portfolio that beats inflation. And it won't come as a surprise that the vast majority of the portfolio should be equities. That's going to give you the actual real growth. It's going to give you your dividend income, and you know that over a long period of time, regardless of all of this, when you zoom in, when you zoom out, the markets increase. So 60-70% of your portfolio should be into equities. Then got your inflation specialist assets, 20 to 30%. Got your REITs, your TIPS, and your energy and materials sector funds as well. It's really important as well to have your currency diversification there as well. So you might have international bonds, you could have emerging market stocks, foreign stocks. Again, foreign will be outside of your home country. I always use the US and UK as the example. And you've got your precious metals and more niche stocks. Right. But it all depends on how old you are. So for somebody in their 20s, or even 30s really, early 40s, wouldn't necessarily recommend having 30% into fixed assets. Again, middle-aged investors, your mid-late 40s, you might have a slightly different approach. Now if you're an older investor, perhaps you wouldn't want to have 60% in equities. You might actually go the other way, 40% into equities, 30% into equities. So, what's really important is that you have professional advice, you know what you're doing, your advisor knows what they're doing, you rebalance and review regularly. Okay? But the bottom line is, inflation isn't something that is coming, it's always there, and the people that will benefit are the people that understand how to beat inflation. Okay? And yes, you can have these great fixed deposits that will lock you in for 24 months, 36 months, 18 months sometimes. But the reality is, if they return less than inflation, you are losing money. Okay, so I've given you a couple of strategies I've outlined on this video. That'll be equity positioning, real estate, commodity hedging, international diversification, and these aren't just like theories, these are proven concepts, and these approaches work, and they've provided protection, they have provided wealth, growth over time. Okay, so inflation requires protection, but buying a few REITs and a couple of gold ETFs isn't going to do it. You need a comprehensive strategy that balances out growth, income, inflation protection across multiple asset classes. Okay, but most importantly, it requires an understanding of your specific situation, your age, income, what you need, where you are, your risk tolerance, your capacity for loss, your time horizon, tax considerations. They all have an impact as to what assets you should be holding. So yes, it's great to understand, but any portfolio should be bespoke to you. Okay, so thank you so much for watching. Any questions, comments, send me a DM or put a note below. Thank you.